The IRS has a secret weapon, and most high-income earners have no idea it's sitting right there in the tax code, waiting to be used against them or for them. We're talking about a loophole so powerful that, when executed correctly, it can wipe out tens of thousands of dollars in taxable income, and when executed wrong, it sends up a flare directly to the IRS audit team. Let's back up to 1986, because that's when Congress drew a line in the sand with the Tax Reform Act. They said passive losses, think rental properties sitting there collecting rent, cannot offset your W-2 income or your active business profits, full stop. For decades, that rule has quietly crushed the tax streams of doctors, engineers, and entrepreneurs who thought owning a rental property meant automatic write-offs. But here's where the story gets interesting, because the tax code always has a backdoor, or in this case, 11 of them. The short-term rental loophole is the exception that rewrites the rules entirely, and it exists because of a very specific distinction the IRS makes between passive investors and active participants. To qualify, you have to personally log more than 100 hours of active management in your short-term rental. And we're not talking about scrolling Airbnb at midnight in your pajamas. We mean documented, IRS-recognized activity types that fall within their 11 qualifying categories. And you cannot hand the wheel to a property manager who logs more hours than you do. Think about that for a second. The strategy literally requires you to be more involved than anyone else in the operation, which is the tax code's version of saying you actually have to run this thing. It's almost poetic that the government's own rules demand you be a real participant in your investment, not just a passive recipient of someone else's labor. Now layer in the One Big Beautiful Bill, which restored 100% bonus depreciation for qualifying assets placed in service after January 19th, 2025, and the math starts looking extraordinary. If you purchase furniture, appliances, short-lived structural components, things that depreciate quickly, you can potentially deduct their entire cost in year one. The irony here is almost too rich. The same tax system that spent decades protecting itself from real estate write-offs just handed high-income earners one of the biggest deductions in recent memory. And most people sitting in the 40% combined federal and state tax bracket have absolutely no idea this window is open right now. But here's the part where we have to be honest with you, because this strategy has nuance built into every layer. The IRS isn't naive. They've seen the abuse cycles before, from accelerated depreciation in the 70s to the shelter schemes that triggered 1986 in the first place, and they know exactly what aggressive tax planning looks like. Getting audited on this strategy is genuinely the worst case scenario, because the documentation burden is enormous and retroactive. You need contemporaneous logs, meaning records kept in real time, not reconstructed later, and every hour has to map to one of those 11 qualifying activity types, or it simply does not count toward your threshold. The psychological trap most people fall into is assuming that because the loophole is legal, it's also easy. And that is exactly the kind of confident carelessness that ends in a penalty assessment with interest. Discipline here isn't optional. It's the entire foundation the strategy is built on. What history teaches us consistently across every tax cycle is that aggressive strategies survive scrutiny when they're built on process, not just conviction. You don't win by having a great idea. You win by executing that idea with the kind of documentation that makes an auditor's job boring. So if you're a high-income W-2 earner or a business owner staring down a massive tax bill this year, the short-term rental loophole isn't a gamble. It's a calculated, rules-based strategy that rewards preparation and punishes shortcuts. Position size matters too, because buying the wrong property in the wrong market just to chase a deduction is trading a tax problem for a real estate problem. The philosophical truth underneath all of this is that the tax code isn't your enemy, it's a system with rules, and systems reward people who learn the rules better than everyone else. Preparation is the whole game, and comfort with any outcome comes from knowing you did it right, not just that you did it. Whether the deduction saves you $50,000 or the audit never comes because your paperwork was bulletproof, both outcomes are acceptable when your process was sound. That's the mindset that separates sophisticated investors from the ones who get excited in October and scrambling in April. If you're ready to explore whether this strategy fits your situation, Or if you need help with real estate investing, connecting with lenders, or finding contractors for your short-term rental property, check out the links in the description below.